Hello, everyone. Thank you for joining. We'll give people a couple more minutes before starting the webinar, in case there are some late joiners. So bear with us for a couple more minutes. Right. I don't see anyone else joining, so we're going to get started. Thank you very much for joining this session. We look forward to walking you through some of the FINMA nature-related risk requirements from the circular that was released a few weeks ago. We're just going to cover some of the topics here on the agenda. So today we'll start with a quick introduction to nature risk, what it is and why it matters now. Then we'll move to the FINMA regulation and the circular in particular to unpack how nature-related financial risks fit into the upcoming regulatory requirements. Then we'll look at how to identify and quantify those risks at the portfolio level before giving a short overview about NatureAlpha and how our data supports this work. And finally, we'll open it up for a Q&A. Before we start, we just wanted to tell you who you have presenting today for NatureAlpha. So you have Liesl, with our head of policy analysis, myself, head of client engagement, and Harry, our product manager. And we will all take turns in explaining a bit about our approach to the compliance, but also how to operationalize this. So starting with nature risk, when we talk about nature risk, we are referring to the potential financial, operational, and reputational impacts that arise from how companies both depend on and impact the natural world. This risk can stem from many sources, from physical disruptions like floods, wildfires, and droughts, to wider systemic issues like biodiversity loss or soil degradation, all of which can directly affect business continuity, cost, and supply security. In the same way that climate risk reframed carbon exposure, nature risk really highlights how environmental degradation can translate into measurable business risk. Now, we divide nature risk in two broad categories: physical and transitional. Physical risks come from the degradation or loss of natural systems themselves, things like floods, droughts, etc. And the transitional risk, on the other hand, emerge from the world's response to those pressures, policy changes, investor expectations, new regulations, and the rapid shift towards more sustainable business models. Together, these categories give us a full view of how nature-related issues translate into business exposure, both today and in the future, where nature and finance are increasingly interconnected. Now, to go a bit deeper into defining what we mean by assessing nature-related risk, really the emerging consensus is that it requires a structured, data-driven approach that mirrors how financial or climate risk is handled. So the best practice is to break the process into three key phases aligned with the TNFD framework: locate, evaluate, and assess, each building on the previous one to create a clear, measurable picture of exposure to nature-related risks. So first, locate. This step focuses on identifying where a company's activities interact with nature by mapping asset locations against geospatial data sets, for example, areas of high biodiversity importance, ecosystem integrity, or water stress. We can pinpoint sensitive locations where business operations are most exposed to nature-related risk. Next, evaluate. Once those locations are identified, we look at how a company both impacts and depends on nature across its own operations and its supply chains. And this includes assessing pressures like emissions, land use, water withdrawal, etc. Standardized scoring methods such as Z-scores make it possible to compare performance between companies and across sectors. And then assess when the final step looks at how well those risks are managed. This involves reviewing governance policies, disclosures, and participation in stewardship initiatives to understand what proportion of risk remains unmanaged. When all of these layers are combined, geospatial exposure, operational and supply chain impacts, and governance quality, they can be aggregated into a single nature risk measure. And this type of framework allows organizations to quantify and benchmark their exposure and align with evolving reporting frameworks like TNFD, GRI, and CSRD, and ultimately translate nature risk into a forward-looking financial metric, often expressed as nature value at risk, or NVAR. I'll hand over to Liesl to tell you more about the new FINMA.
Hi everyone, great to be here today discussing the new FINMA circular that was released last year. So what we can start with is just kind of a very high level scope of FINMA and the differences that to a couple of the other frameworks that I suppose most of us are quite familiar with at this stage. And so to start with, FINMA follows the NGFS definition of nature-related financial risk. So that's split into two parts. So it's the degradation of nature, so the loss of ecosystem services, physical risks, but then also the misalignment of economic actors. So these are kind of the transition risks that Nico was speaking about before. So kind of the policy, the market exposure. And so when you compare FINMA and TNFD, SRS, CSRD, the main difference is that FINMA focuses on the full integration of nature-related financial risks into the risk management structures that are already existing in these financial institutions. So in a different way to the other disclosure frameworks that have quite similar disclosure pillars, they also provide a disclosure format, so boxes to tick, as it were, i.e. there are certain things that you need to discuss in order to complete that disclosure, whereas FINMA is more of a principles-based approach, so it doesn't prescribe a fixed format, but it has lots of requirements that should be integrated in general, almost so that nature becomes something that you're doing every day, rather than just something to satisfy a regulatory disclosure. So then if we move on to the next slide, so these requirements have been released by FINMA, and so kind of the first date for the diaries is January next year. And so for category 1 and 2 institutions, so these are the largest financial institutions, it's just climate related risks to begin with, so into governance, risk identification, lots of things that probably would have been happening already, as we know, climate regulations have been around for a lot longer than nature. Then by January the year after, 2027, again, this is for slightly smaller institutions, but still just climate at this point. And then by January 2028, all institutions need to implement the full scope of nature-related risk management. So this is climate plus biodiversity, ecosystem, and nature-related risks. And so kind of the idea is that most of these institutions, you kind of have 2 years now to start to integrate nature or get into nature if you haven't already, so that by January 2028, this is something that is kind of a day-to-day activity for most risk management frameworks rather than something new. So if we go to the next slide. So in terms of who does it concern, for the mandatory disclosure is for banks and insurance companies, and recommended is asset managers, portfolio managers, securities firms, fintech companies, and then also blockchain companies. And the key requirements are things that you'll probably be quite familiar or you would have heard already. So governance structures, then also this identification and materiality assessment, as Nico was explaining earlier, but then also scenario analysis. So the monitoring of climate and nature-related financial risks through scenario-based analysis. So that's including stress tests, as you can see, and that is all to be integrated into things that you're running already. There's also the element of risk management. So actually integrating the risks that you're seeing into the management framework, but then also key part of that is the monitoring and controlling of that, and that is also suggested to be done under scenarios. For banks and insurers, they have slightly different approaches. So for banks, the inclusion of material nature-related risks and due diligence, and for insurance, that's that nature-related risks are included in products. And there's a lot more information in the actual circular about the differences between banks and insurers. So the reporting categories, again, things you've probably seen before, but the biggest thing kind of to emphasize is that all of this becomes integrated. So you're not just filling out a form to then send off. It's the way that you then start to treat nature moving forward as an institution. So you have governance strategy, risk management, as we've said, but then also customer and market conduct. So how are you engaging with your clients, with the investments that are being made? And then also kind of within all of this is that regulatory compliance. So almost underneath FINMA sits the TNFD, the ESRS type things that you'd have to do anyway. And then there is also a technical and data submission part as normal, but this is more for just to prove kind of that you are like being regulated by FINMA, rather than in order to be completely compliant with FINMA, you have to submit a report. And so now if we look at kind of how we would actually identify nature-related risk. And so one of the things that we kind of view as the steps, as it were, and this is kind of similar to lots of different things in the frameworks already, so similar to the LEAP process, is you would start by kind of looking at the companies that you want to work out the risk. So you upload the ISINs or the weights of public securities, but also asset location, operational data, that sort of thing. So basically, most of the starting data you have. The first step is then kind of this materiality mapping. So leveraging company revenues, and then you can do this across impact drivers and ecosystem services. And so that gives you an idea of kind of where within your portfolio are the sectors that are the hotspots for risks, which are the sectors that are having more impact, which are those that are more dependent based on ecosystem services. And it also gives you an understanding of, as a whole, where do those companies within your portfolio fall in terms of risk. Then obviously, as we're talking about nature, we have this like location specific element of it. So you have to do a geospatial mapping to understand where is your interface with nature on the ground level, where are your assets located? Are they near key biodiversity areas? Are they near areas of water stress? So you kind of start with the sector identification and then you move to actually put it in context of nature. And then at the end, the governance assessment. So this is really key to engagement, especially to understanding what those companies in your portfolio are doing to mitigate against risk. And there's, for example, you could have a company that has very high impacts and has a lot of dependencies, but actually has really good mitigation in place. And so that could bring down their risk overall, compared to a company that has the same type of impacts and dependencies, but no understanding of their mitigation. And so this engagement piece at the end is really important, I think, with the integration overall in how you approach investments with nature in mind. And then if you go to the next slide, this then allows you overall to get these assessments of risks, impacts, opportunities, and dependencies. So for risk, it's, as we said, kind of the physical and the transition risks. So looking at something like water risk, for example, and if you had a
I think we're having some network issues. There's been an issue with Liesl. We're just going to see if we can get her back in a moment. Well, while we wait to getting Liesl back, let me just. Okay. Forgive us for one moment. We're just going to see if we can stop sharing and getting the presenters back. Just bear with us a second. All right, let's see. I think Liesl, you're back, right?
Yeah, sorry about that, guys. That's the classic central London Wi-Fi for you. So yeah, as I was saying, there's going to be lots of opportunities that will emerge over the next couple of years. And there are some specific data sets already that allow you to quantify those. For example, the IUCN IBAT species threat abatement score. Then if you start to look at actually what's happening on the ground, so these impacts and dependencies, for example, emissions, pollutants, but then also biodiversity and land use, so what the actual operation of those assets, how is that impacting on biodiversity, but also in the same way, what from nature are those assets or those locations dependent on to operate? Things like water availability and quality, which is a big issue for data centers, specialty chemicals, soil quality is a massive thing for agriculture. And so overall, that kind of framework, those beginning 3 steps, allows you to get a lot of oversight on what's going on your portfolio on a very location specific basis. So if we go to the next slide. And I will now pass over to Harry, who's going to give you a bit of a rundown into how you would deal with the findings that you get at the very end of this first look at materiality.
Thanks, Liesl. Yeah, so I'm going to dive into a bit more of the nuts and bolts of the product, and exactly what type of insights we can extract from the different phases of sort of risk assessment, how they relate specifically to FINMA and broader as a sort of risk management strategy, and really focused on the context of FINMA being, as Liesl mentioned before, that FINMA isn't prescriptive in terms of exactly which metrics that it requires you to report, but instead it's really focused on having an integrated risk management process. And so for us, that means developing the right tools, the right data products that can suit the different areas of risk management. So at this level that we're looking at here, it's by looking at at the company level, as you can see on the left-hand side of that chart, at the company level, these are sort of the higher level risk metrics that we can use to start to prioritize different interventions. Perhaps we're building screening processes and whatever. And so we're looking across different aspects of risk here, including exposures by sector, priority locations. So that's the geospatial aspect, looking at the share of the spread of the high risk locations underneath one of those companies, and then the risk management being assessing the policies that these companies have in place and using that as a key metric as well to understand, well, what is the risk that this company is effectively managing or not managing these risks that it has. So using the combination of these metrics, we can start to get at a high level prioritization of the specific companies. We've then gone, and so you can see Novartis here as an example at the top of this particular list, is most exposed on a physical basis. So if we go to the next slide, then we can start to dive deeper into a specific company and uncover specific insights that we can extract out of the different data products that we have. So keeping in mind that when we're thinking about FINMA, we're really focused on the material or the dependency aspect of materiality. So looking at the nature-related financial risks. So that is the risk posed to a company or to an asset from nature, and not so much as about the impact that these particular companies are having on nature. Although in some cases that would also pose a risk for reputational. But in this case that I'm looking at here, I'm looking at the impact that nature-related risks has on the assets that underlie Novartis as our example company. So we've got the location information about the assets. We've got the information about the types of assets owned by the company, managed by the company. And we can use our financial materiality assessment to start to say, well, where is the key nature-related financial risks within Novartis's operations? And with regards to FINMA, we're really focusing on 3 key aspects here to solve for, and that's to have forward-looking assessment. So starting to think about not just what's the state of nature and those sort of things, but also how is it expected to change over time and what risk does that pose to the company. Making sure we have some sort of quantitative measure to assess this and making it consistent across assets and across companies. And making sure that we're addressing the unique interactions between a company's operations and nature, because depending on the type of company it is, the type of assets it operates, it's going to have quite unique interactions with nature. So we want to make sure that we're capturing that nuance and not just treating sort of any location as the same. So the way that we address those things is by using this concept of operational deficit as a measure. An operational deficit captures the future potential loss at the asset level as a percentage of operations based on different nature-related scenarios. So those scenarios that we're using are aligned with the SSP and RCP climate policy scenarios. And essentially for each asset, given its type, given its location, we can get a unique projection of the expected loss based on its specific interactions with nature and based on the outcomes of nature under those scenarios. So that's our operational deficit concept. And then we also break that down further into how that operational deficit materializes in the different value drivers at the asset level. So saying not just, okay, how is this impact experienced, but how is that split between its impact on revenues, operational expenditure, and capital expenditure. And the important thing about that is that if you have extreme impacts to an operation, sometimes those extreme impacts will materialize as higher proportional CapEx impacts. Whereas if it's a low impact sort of effect from nature, such as productivity loss slightly on an agricultural asset, it might be felt more on the operational expenditure or revenue-based impacts. And so we capture that nuance in terms of that extremity as well. So here you can see a specific asset as an example. So we're diving right down into a specific asset under a specific company after we've done that high-level filtering. And we can see that under this specific scenario, the total operational deficit felt over a 25-year period for this asset is up to 52%, and that's split out into 23% revenue-based impact, operational expenditure 21%, and 8% for capital expenditure. So we can then go further and extract even more insights out of how we're actually measuring this, and this really takes us into helping us inform mitigation strategies, or how do we actually use this information to do something about it. So because our models are specific in terms of not only the projections of nature-related change, but also how that materializes at the asset level, we can actually isolate out the specific effect that's having the most impact on this asset. And for this specific asset, it is water-related risk. So water scarcity and quality is the main driver of the impact on revenue deficit in this specific case. And if you go to the next asset example, then Nico, this specific asset might look quite similar in terms of its overall operational deficit of 52%. But what we can see is that the underlying effects and which value drivers it affects at the asset level is actually quite different. So this one is more impacted by soil protection, coastal resilience. So that potentially has a higher sort of physical impact on the specific asset rather than being an element of productivity. And so that's why we see those proportionally higher OPEX and CapEx numbers there. So yeah, coastal erosion, for example, generally has a high operational expenditure and capital expenditure sort of weighting, whereas things like water availability, and things that affect productivity, such as soil quality, perhaps, might impact revenues or operational expenditures more highly. So as you can see, if we go back to where Liesl started on that, the process of filtering down at the company level, down through to identifying high-risk companies based on their policy drivers and their context of industry and products, and then going right down into that detail of, okay, let's isolate the specific drivers of risk on the assets that are in these risky locations. So with that and more detail, we can provide more detail with sort of materials around this as well if you're interested in kind of how we get to those numbers, but I'll hand it back over to Nico at this point. So
Yes, I think it's still you for that one.
Oh, sorry. Yes, I'll finish up on this slide. So, yeah, just reiterating the point that the FINMA circular is really focused on nature-related financial risks. So that's how we're looking at that sort of one-way materiality, let's call it, of the impact of nature-related risks on operations for a company, but also how do we integrate that into a broader risk management approach. And that's where we've got these different levels of risk management for portfolio level assessments, company level assessments. If you've got sort of, analysts who are looking specifically at risky assets, sort of having tools in place that they can manage nature-related risks at the really high resolution level, and not only at that portfolio management level. Doing this in a way that is consistent, but also requiring minimal amount of input from a user as well. So with this, we only generally need ISINs, perhaps. If you've got your own asset locations in a private portfolio that you want to assess, you could bring them into the system as well, but only looking at sort of asset type or industry and location, rather than having to have complex financial data integrated before you can get these really in-depth outputs. And then, yeah, that core concept of operational deficit, and how that not only relates to FINMA, but it really sets a foundation for assessing nature-related risks, and as an extension, the nature value at risk at the asset level, and we can aggregate up to sort of company and portfolio level of that as well.
Yeah, lovely. Thank you. Thanks, Harry. Thanks, Liesl. So what we just wanted to, what we've done to make it more practical is that we've put together a simple roadmap to FINMA compliance, which you'll also find in the fact sheet that we'll share after the session. And what it does, it outlines 5 clear phases, from understanding and assessing your current data gaps, to designing your framework, integrating the data, and running dry cycles before final submission in 2028. We're really seeing that working with a range of customers, that sometimes there's an underestimation of the time that it takes to run those processes. And the key takeaway here is timing. Firms really do need to start now. Building the data foundations, governance processes, and internal awareness does take time. And starting early means you're not just compliant, but you're also confident when the reporting goes live. I just want to tell you a bit more about NatureAlpha. I see there are some questions in the Q&A, so we'll get to that in a moment. If you have more, please feel free to add them to the chat. But across the market, we're really seeing investors and regulators demanding a far greater and clearer understanding of nature-related risks. No, not just climate, but biodiversity, water, land use, etc. And the challenge is that much of this risk is still invisible or unquantified. Our work really focuses on making those unseen risks measurable and comparable. And by combining AI, geospatial data, and company level information, we help financial institutions quickly assess where the exposures lie and respond efficiently to new regulatory requirements from bodies like the ECB, FINMA, TNFD, etc. So the goal isn't just compliance, it's really giving decision makers the confidence to act on nature risk, as they already do with credit or climate risk. So as the market matures, we're really noticing 4 main ways institutions are starting to use nature data. The first is risk management, screening portfolios for exposure and dependencies to identify material hotspots. Then there's reporting, where firms are aligning disclosures to TNFD, FINMA, SFDR, and they need credible and modeled data. Stewardship is becoming another big driver. Investors want to engage with companies and with evidence-based insights on governance and impact. And finally, impact identification. So where data helps locate opportunities for mitigation or adaptation on the ground. These use cases reflect a clear shift. Nature isn't just an ESG topic anymore, it's a core financial consideration. And underpinning all this is a data architecture that reflects how investors think about risk. We start with materiality assessment, understanding how dependent or impactful a company is on nature. Then geospatial analysis links that exposure to specific asset locations, showing where risks are physically concentrated. Biodiversity footprinting goes a step further, quantifying the degradation of ecosystems and species over the full life cycle of operations. And governance analysis ties it all together, evaluating how companies are managing those risks and whether their policies meet emerging standards. It's a structure that turns complex environmental data into something investors and financial institutions can benchmark, compare, and act on. And everything that we've learned from clients over the last few years has gone into this next generation of our platform. So the Geoverse brings together geospatial visualization, portfolio analytics, automated reporting in one place. It's designed for speed and clarity, allowing users to explore nature exposures across thousands of assets in seconds, benchmark portfolios, and generate disclosure-ready outputs. Behind the scenes, we've expanded data coverage, improved calculation speed, and built in an enhanced materiality matrix for even more nuanced insights. And the real goal here is usability to turn a complex and emerging risk area into something financial institutions and corporates can engage with intuitively and repeatedly. That brings us to the end of our overview. I think we very much stick to the 30 minutes we had planned. So we've covered quite a bit from defining nature risk to what compliance looks like in practice. Now I'll pause here, have a sip of water as well, and we'd like to take a few minutes to dive into your questions and hear what's top of mind for you. So we'll just take a minute to go through the Q&A questions now, and we'll answer them as we receive them. So just give us 1 minute when we do that. So one I could see maybe for you, Harry, is like, how do you predict nature-related risks in the future? We haven't really gone into the details of what scenarios we're using, so maybe it would be helpful to use that.
Yeah, so future nature-related risks are assessed using a combination of scenario-based expectations and predictions about nature outcomes. So that would be predictions about the change in the availability of ecosystem services, for example, if we're talking about water availability, but it also could be expectations or predictions under these scenarios of the increase in specific nature-related hazards. If we think about sort of pollution or erosion, coastal erosion. So these predictions about future nature scenarios are based upon, at the moment, we're using 3 key scenarios that are developed as kind of a combined policy and environmental climate scenario from the using the SSP and RCP scenarios. So they're combined policy and climate scenarios, basically. So one of the scenarios, for example, is a fossil fuel development scenario, which relies upon a huge number of kind of economic assumptions about the future development, availability of resources, treatment of resources over the next 25-year period. And then we have 2 other main scenarios, but essentially these are narrative-based scenarios. So we're not saying, okay, what if there's a 10% increase in X resource? We're using a holistic kind of economic, social, policy scenario to define these scenarios. And that is actually something specifically, outlined from FINMA to use narrative-based scenarios, but a lot of frameworks and regulations that are starting to adopt this view of nature-related financial risks rely heavily on narrative-based scenarios. And it's really a way of addressing the complexity of so many interacting elements. So if you can have this narrative-based scenario, you can have sort of a realistic image of how do all of these resources and hazards change under high-level economic and political predictions. So once we have those predicted futures of nature outcomes, then we use damage functions to basically translate those futures into an impact on an asset. And that depends on a specific damage function for each asset type. So, if we're going to, I think there was another question here about sort of how do we assess a textile retailer for their cotton sourcing operation, for example. If we're looking at those specific types of assets, then we basically look at the interaction of the different ecosystem services, the different exposure to different hazards for a specific asset, like an agricultural supply shed or an agricultural asset, production asset. And that will be the kind of level at which we're then translating those futures of nature-related changes to an impact on the asset. Each of these kind of brings in a different level of complexity and specificity. The key piece here is that we can diagnose specifically what we are predicting. So we can say, under this scenario, we're getting this operational deficit, but at every point we can say, well, that is predicted because we're assuming this relationship from this asset to this specific resource. So let's think of an example such as an asset where we've said there's going to be a 30% loss in operational productivity due to water scarcity, but that particular asset might already have very clear, robust protection policies in place for water availability in the future. So if that's the case, you can diagnose exactly what resource change, hazard, or change in ecosystem services driving those numbers, and that's kind of a key point with these damage functions, to keep that transparent and keep that as sort of those linkages clear.
Right, thank you, Harry. There's one question on greenwashing. So, what about the aspect of greenwashing, explanatory notes, and the role of compliance departments? Liesl, would you like to take that one?
Yeah, so I think that, I mean, I'm not 100% sure in terms of the context, but in terms of greenwashing, I think that from our perspective with nature, you very much start from the ground, quite literally, as it is so location specific. And so I think that if you are presenting the data as it is coming through, then it's quite hard to greenwash, I think, because the data will come across in terms of it is going to portray the impacts that the impacts that the sectors are having, the impacts that the locations are having. And I think that one thing that can help with that is greater granularity. So going for the highest amount of granularity that you can have. So in terms of the most specific location kind of data that you can get, and understanding impacts and dependencies very much in like a short distance kind of out from the location. The role of the compliance department, I think, again, is quite similar in terms of ensuring that the data sources, a lot often we say like scientifically ratified, that the data providers understand and have people in their team that specialize in things like location specific data, geospatial data, so that the insights that you're getting out of that type of data are correct, and you're not skewing your portfolio based on data that maybe isn't that accurate. But again, we do have kind of more resources, and we're happy to walk you through in more detail, like the different types of data and how you'd go from start to finish, kind of making those types of reports in the context of compliance.
Right, thank you, Liesl. There was one question from Tana. Many African conservation and land use projects depend on healthy ecosystems. How adaptable are NatureAlpha's model to regions like Namibia, where data availability may differ, but biodiversity importance is very high? Just maybe to give a bit of an overview on that, that's a great question and an important point. So our models are designed to be globally scalable, but locally adaptive. So we mentioned some of the layers that we are using, like the IUCN, IBAT layers, for example, and they give consistent coverage for key indicators like ecosystem integrity, biodiversity importance, land use change, etc. And so in places like Namibia, that means we can still model nature sensitivity, dependencies, and pressures using the high resolution satellite and ecological data that we have, even where on the ground disclosure is limited. So really the approach is to start with global consistency, then we can layer in regional context and project level data as it becomes available. But the framework has to remain credible, as we've just talked about, comparable, and also relevant to areas of high ecological value. I think there was another question as well. I'm trying to juggle with a Q&A. Do you need a company to provide the asset values in addition to asset locations to assess the potential financial impact? Harry, would you like to kind of take that one maybe?
Yeah, sure. Could you just repeat that? I don't think that question's come up here.
Sorry. Yeah, so it's, do you need the company to provide the asset values in addition to asset locations? Yeah.
So the short answer is no. So operational deficit, we've made it a sort of proportional loss value for a reason, and that is that we can look at these assets irrespective of their current value. Now, the challenge with that is, you might get an operational deficit of 10% for an office building because of, surrounding or increased costs or erosion or something like that. But then for a very, very high value asset, such as a mining operation or a large agricultural production area, you might have also a 10% loss, and trying to equate those is obviously pretty obvious that you more want to focus on the high value asset. So to start with, what we have is a fairly coarse sort of attribution of asset value based on sort of what our assumptions are about how critical that asset is to a company's overall operations. That just allows us to weight the importance of the assets when we're aggregating up to the company level. But as a product, what we kind of encourage users to do is, because you can access the data at the portfolio level, the company level, and at the asset level, that more granular value information and kind of financial data about the relative value of each asset can be combined with the asset data to do more meaningful aggregations. So we have our own sort of assumptions around how we aggregate up, and that depends on the value of the asset, but the data is at a kind of fine enough granularity that it can be kind of changed with user data, but it's not a prerequisite for being able to access this data in the first place.
Right, thank you, Harry. There was another question that we're almost out of time, but there was one around how does this model help to assess nature risk from supply chain perspective, where BlackRock expressed their view on this issue. For example, how do you assess the nature risk of a textile retailer for their cotton sourcing operation and its related risk with these tools? So first of all, it's a great question. And also, it was a great read as well for that particular BlackRock commentary. And first of all, I think there were some takeaways that we were all happy to read. First of all, that nature capital is financially material. There was this focus on land use, water, and biodiversity that we are seeing across our customers as well. The fact that alignment with a model like TNFD is important, and that BlackRock expects companies to adopt or map to TNFD and of course ESRS, CSRD over time, and also keep in mind that it's important to have that robust natural capital management might gain operational efficiencies, innovation, resilience, etc., which I think is important. In the context of the supply chain and how critical they are, it's exactly the kind of issue that our framework is designed to address. We look at supply chain nature risk in the same structured way we assess direct operations, really starting with geospatial exposure to locate where sourcing takes place, for example, the cotton growing regions, and then overlaying with that with ecosystem integrity, water stress, biodiversity importance, etc. Then we evaluate the impact and dependency of those activities. And finally, we assess governance. And really, it is about having access to that high resolution geospatial data and going to asset specific information, which we can then use in order to map entire supply chains. And in the case of a textile retailer, that means would you be able to trace and quantify that nature risk right through the cotton supply chain, and again fully aligned as well with TNFD. So very much aligned with the comments from BlackRock in terms of the importance of managing nature risk across the value chain, and how companies can engage suppliers, which we are seeing a lot of our customers do more and more often now, to trace inputs and really mitigate those adverse impacts in their upstream operations. I think we're out of time now. We maybe had one or more or questions to go through. So what we'll do is that we'll go through the Q&A and respond to everyone individually. As I've mentioned before, you all have access to, first of all, we'll send you the deck from the webinar and also the fact sheet that we've designed to understand, FINMA compliance. And then if you have any more questions, obviously feel free to reach out to us. We'd be very happy to continue that conversation, understand maybe your own specific use cases and what questions you might have in particular. So thank you very much for your time today. We hope you have a great rest of the day, and we look forward to engaging with you again soon. So thank you very much.